Most people believe the only way to build wealth in the stock market is to buy low and sell high. They wait years, decades for their portfolio to tick upward. But what if I told you that some of the greatest fortunes in history were made while the world was panicking? In 1992, one man made $1 billion in a single day by betting against the British pound. In 2008, a handful of traders turned millions into billions while the housing market collapsed. They weren't buying the dip. They were doing the exact opposite. Today, I'm going to show you the mechanics of the most misunderstood tool in finance: short selling. It's a strategy where you can literally make money as a stock's price drops to zero. But be warned, if you get this wrong, your losses aren't just limited to your investment. They are theoretically infinite. Why are we talking about this today? Because we are entering an era of the great decoupling. For the last decade, a rising tide lifted all boats. Cheap money and low interest rates made buy and hold look like a stroke of genius. But that era is over. In a volatile market, being a long-only investor is like playing a game of poker with half a deck. You're ignoring 50% of the price action. Whether it's overhyped AI startups or struggling retail giants, there are companies today that are fundamentally decoupled from reality. Understanding short selling isn't just about gambling on a crash. It's about asymmetric information. It's about spotting the cracks in the hull before the ship starts to sink. If you don't understand how the shorts think, you're essentially flying blind in your own portfolio. Short selling feels like magic, or perhaps cheating, because you are selling something you don't actually own. Here is how it works in the real world. Imagine your friend owns a rare first edition book currently worth $100. You are convinced that next week a massive reprint will be released, and the value of that first edition will plummet to $60. First, you borrow that book from your friend. Second, you immediately take that borrowed book and sell it to a stranger for $100. You now have $100 in cash, but you owe your friend one book. Third, you wait. The reprint happens and the market price drops to $60. Finally, you go into the market, buy a copy for $60 and hand it back to your friend. You started with nothing. You ended with $40 profit, minus a small borrowing fee. In the stock market, your broker is the friend. They find shares from other investors, lend them to you, and you sell them instantly. This is called covering your short when you buy them back later. But this is where short selling becomes the most dangerous game in Vegas. This is the math of infinite risk. When you go long, meaning you buy a stock, your math is simple. If you invest $1,000, the most you can lose is $1,000. The stock goes to zero, you're out. Your upside, however, is theoretically infinite. Short selling flips that math on its head. Your upside is capped. A stock can only go to zero. If you short a stock at $100, the most you can ever make is $100 per share. But your downside? It's a black hole. If you short a stock at $100 and it rockets to $500, $1,000, or $5,000, you still have to buy those shares back to return them to the lender. This leads to the short squeeze. When a stock starts rising rapidly, short sellers panic. They all rush to buy shares to close their positions at the same time. This massive wave of buying pushes the price even higher, forcing more shorts to exit. It's a feedback loop of financial carnage. Now, short sellers are often vilified. CEOs call them vultures or market manipulators. But in a healthy ecosystem, you need vultures to clean up the rot. Short sellers are often the first to spot corporate fraud. Think of Enron or Wirecard. These weren't bad luck stories. They were massive deceptions. While traditional analysts were busy writing buy reports to keep the companies happy, short sellers were digging through the tax filings and the forensic accounting. They provide liquidity and price discovery. Without the threat of someone betting against a company, valuations would stay artificially inflated forever, leading to even bigger bubbles and more painful crashes for the average investor. But here's the nuance most FinTalk gurus won't tell you: the cost of carry. When you own a stock, it costs you nothing to hold it. In fact, it might pay you dividends. When you short a stock, you are effectively renting shares. You have to pay stock borrow fees, which can be massive for highly sought-after stocks. Furthermore, if the stock you are shorting pays a dividend, you have to pay that dividend out of your own pocket to the person you borrowed the shares from. My pro tip: never short a stock just because you think it's overvalued. Markets can stay irrational longer than you can stay solvent. Only short when there is a catalyst, a specific event like an earnings miss, a regulatory change, or proven fraud that will force the market to realize the truth quickly. Short selling is a high-octane tool. For 99% of people, you should never actually hit the sell to open button on a single stock. It's too risky. However, you should use this knowledge to protect yourself. Your task for today: go to a site like shortsqueeze.com or MarketWatch and look up the short interest of the largest position in your portfolio. If the short interest is above 10%, it means professional smart money is betting heavily against your company. Find out why. Read the short reports. You don't have to agree with them, but you absolutely have to know what they see that you don't. If you found this breakdown helpful, hit the like button for the YouTube algorithm. It helps more than you know. And if you want to see how to hedge your portfolio using put options, the safer way to bet against the market, click this video right here. I'll see you in the next one.